Friday, Pat.
Hey, Rick, how you doing, sir?
Well, I was sharing some YouTube analytics yesterday, and one of the things that I picked up on was that viewers from Texas only hang in and view for 11 seconds. So on Fridays, that's all they see is Happy Friday, Pat, and then they're gone. They cut out. I don't know why it shows that. And then, remember how I told you we were having, there's one person that hits the dislike button, and YouTube doesn't, and it doesn't bother me. YouTube doesn't really care whether you like the video or don't like the video, but they like to see interaction. So if I got 200 people didn't like my video, YouTube will put it in front of more people, oddly enough. But that one person's been kind of gone for a couple of videos, but they came back the day before yesterday. So now I just kind of looked at it and go, "Hey, dude, welcome back." So it's just nothing to get worked up about. And yeah, Terry, was it me? It probably was. Terry sent me the funniest video today, but I can't put it here because it's about the cough, and it's somewhat, I wouldn't say inappropriate, but I'll send it to you, Pat. You'll love it.
Sounds good.
So, gosh, what do we want to cover? There's so much. I want to share this. We always talk about the Cromford Report 100, which is, the way that they measure the market. If it's at 100, it's considered balanced. So you won't see prices start going down until we get at a Cromford index of about 80 or below. And now we're at Avondale's the worst at 997, Gilbert 686. And you can see here that Chandler's at 644, but just last week it was at 736. So what they're telling us right now, and it's hard for you to read on this, but it says it looks like it's reached a maximum and is unlikely to go higher. Demand readings have declined, especially listings under contract. Unit sales are likely to follow in due course. So what she the peak, and that but that doesn't mean that prices are going to come down anytime soon. And so today we're sitting at, before I forget, we have 38 entries to our Win the Webcam contest. So that means you have a 1 in 10 chance of winning that webcam. So get in there. All you got to do, I put the video on the link below when this thing replays. Just subscribe, like, and comment. Subscribe and even dislike if you want and comment. You'll be entered into the contest.
Today we have there's a consolation still.
Oh yeah, do you still have the ceramic duck?
Yeah, I do.
Okay, good. I thought maybe you'd have it right there at the ready. So today's listing's 4,654 for the 7-day moving average. We had 4,253 homes come on the market, and guess what? We sold 4,216. That part isn't changing. While listings are coming up, according to my 7-day moving average, they're still going under contract at the same pace. Now, the Cromford Report is obviously seeing some different numbers that indicate a slowdown. We used to say a couple of years ago that we wouldn't see real estate slow down until interest rates got at 6, and now they're approaching 3.4, 3.5, and it's spooking people already.
Not necessarily that. I mean, I'd say they've gone up from about, on the purchase side, from about 2 5/8 up to about the high 2s, low 3s. We've gone up anywhere from 3/8 to half a point, depending on the lender.
Oh, okay.
Nothing
major. Interesting news out of Minnesota. That's where Target's headquarters is. They're moving out of the city center building in downtown Minnesota.
Yeah, I saw that.
That's 3,500 people, and that building is how big is it? It's going to add, I think there's 1 million square feet in that building. So it's going to affect all the businesses that are around that place, but it's pretty indicative of what's going on in a lot of these major cities, that the downtown offices are just going poof, People want to work from home. That's what's adding to demand. People wanting to buy homes. So here we go.
Yeah.
Couple charts I found, Pat. First one here, I want to show everybody. This is our pricing. Change in monthly average price per square foot by list price. And this shows the prices this month versus this same month last year. Okay. So 400 to 500,000 home values have gone up 15.3%. 225 to 250 home values have gone up 21.2% and disappeared. So there's not much there. So, but that's kind of stating the obvious, right? But everybody's up around 14, 15%, except the 600, 800K is up 7.4. But look at the over 3 million, Pat, very top number, 10.6% this year versus last year. But the chart that says it all, which is when you've been saying all along, is that back here during the silly season, prior to the crash, people were taking the money out of their equity. This is money leaving after refinancing. And the reason the blue line disappears is they didn't count it that way anymore, so the Fed doesn't keep track. But here's where we are now. And this is your zero line. So people are refinancing, but they're not taking the money out.
Yep. That's exactly what I've been seeing the last several years. I mean, they're just people are smarter. I mean, I think it just boils down to the fact they saw like I mentioned in 07, 08, they saw their mom and dad go through it. Now 10, 13 years later, when they're buying a home or they bought a home, they saw that they're not doing the same thing. And they're just they're smarter people. Yeah.
And while we're waiting for things to get easier to buy, people shouldn't lose sight that, you're trying to look for that perfect time to buy when the price is at the low point and sell when it's at the high point. And, if you're going to stay there 20 years, forget about it. Just be happy, because the rate of growth in real estate just continues to go up about 4.3%. And then you're paying it off. So if I just stayed in my house in Seattle, and I think I paid $103,000 for it. Yeah. 103. It's worth $650 now. So it would be paid off. I'd have $650,000 in equity. And, I wouldn't have cared that house pricing was going up or going down. I'd care a little bit now. I'd probably want to sell it, downsize, and do something else. But that's where you should be looking at your housing. People don't travel as much corporately as they used to. So, but I can see you're trying to pull something up there. What are you grabbing?
Oh yeah,
You've got something right up here. That other screen you had looked like algae, so I'm not going to pull that up. So
okay,
nope, that's not the one you want.
Right here, yeah. No, I want. Yeah, this actually. Right,
that looked like your Gmail account.
Yeah, I got about 18 different windows open. This goes back to what I saw.
This is what you want.
Yeah, this is. We're just trying to reiterate. Like I said, we're trying to. You and I have been, obviously we talk every day just about different things, and I have been just. I really try to dig hard at what the heck is going on, because like you said, this has just been an unreal market. But, I see stuff that makes sense. You gather up information, as I say, we're drowning in information, and we're starving for wisdom. I think everybody's doing that right now.
Well, everybody wants to know when it's going to change. When is our current situation going to change? And we don't know when, but I do know this, it will.
Yeah. Well, I mean, you look at the last 10 years. You and I talked about yesterday. It's like, I was trying to say, we got to do a deep dive. And I said, when did this really start shifting? You said about end of 2018 is when we started this shift of, people moving hard after rates started coming down. And then we just saw, these real estate has a different trend than a stock. I mean, people are getting this mentality of short-term trading from stocks. As far as, real estate is definitely a different animal. They go up. The trends go up, they go down, but it takes a little bit longer for the trend to really start seeing. And that's, I think you and I are, it's like, okay, 4,000 homes listed, 4,000 homes sold, 4,000, but there will be a time when like you said, the last year that we've been doing this, I think I'll give the viewers a chance to we'll start to see when that goalpost really starts to kind of move. It might take a month or two, but this article that, it just went over the things, the six simple things proving that this is different than the last time. And they said the mortgage standards are nothing like they were back then. And you see this chart right here. It said the default risk, the product risk. When they say product risk, they mean the stated income loans, the pay option arm, that's the crap that we had in 04, 05, and 06 right down here. And that's, I've been professing that for the last, 12 months since we've been on this. I said it was just a crappy product that people were pushing out. Now you got that mitigated, and you see the borrower risk. I mean, everything's pretty much at an all-time low. It says reasonable lending standards are right here. It has been tight since Dodd-Frank, 2009, 10. And then you got this chart. It talks about home appreciation. We saw in 04 or 05, we saw obviously a little bit crazier. It has been more of a muted. We've been seeing appreciation, but it has been more muted. This one is another chart. Once again, we're repeating the same stuff, but you look at this, it's like 9.6 months versus 2.1. And then I thought this was interesting. You see, I mean, look at this. Single family housing units completed. 05, 06, you had, obviously, once again, like we talk about. But look at this prolonged period. I mean, you had 2000, I think 8, 9, and 10 right in here, 11, 12. You had 5, 6, 7, 8 years. I mean, and this is an average. So we were below the average we've been below the average for the last 12 years.
Yeah, but remember what the narrative was back here? And, and builders weren't building, and what the fear was, because we saw the demographic shift. We saw that there was this pool of buyers out there, right? They were at the buying age. But what was the narrative back then? Why was it people thought they wouldn't be able to afford homes for another 10 years?
I'd answer, but I get the wrong answer. I don't want to be embarrassed on this call.
No, student debt. And so, builders are going, well, we're going to be building homes that nobody's going to be able to buy. Why are we going to start? And they just sat on their hands for a long time during these years.
Yeah.
Nobody thought they'd be roaring back to buy homes. We thought that's it. The housing is going to be stagnated for a long, long time.
Exactly. And you look at the average units, it's below the line it's not just 1 or 2 years. We're talking 12, 13 years has been below the average, because this is going back to 1970. This is 35, 40, 35 years. There was a few dips here and there, but this is a prolonged for 10 to 12 years that we were really below the average units completed. And
but you look back here though, Pat, when you look back at 70, 75, 80 and all that stuff, nobody was as financially devastated then in the upturns and downturns there as they were in 2008. So there was, their little housing downturn. They got skittish. They started building again. It went down. These guys got their ass kicked.
Yeah. They just totally went up in their shell. So I thought that was a really interesting chart. And then, this talks about the median income needed to purchase a medium home price, because there is the numbers in terms of median income and that average hourly earnings. Barry Habib, the guy I follow on MBS Highway, he talks about, people still the affordability is still there. He went through a whole chart. And like I said, this goes back to the chart I wanted to get. That's why I kind of brought this up. This is really the numbers. Once again, I saw this happen in 05, 06, 07. Look at how much equity was pulled out of homes, 263 billion versus 87 billion.
Everybody was driving Hummers.
Yeah. You're almost talking triple the amount of equity that was pulled out. And that's why the cushion is there now, because people didn't get nuts. So that's, once again, we're just, obviously we're giving we're giving stuff. Yeah. That's why we're here. I know I'm sure that people say, well, how do we, I think I talked to you the other day about maybe going a little deeper, what we could, what is the solution?
Here's my first of all, I want to read this comment. Are 3D printed houses the answer? 40 to 50% less cost than stick, and they can be built by a machine in 3 guys in a week. Boy, that's a game changer. I've seen them doing that in China, 3D homes. I just want to go to a job site and watch that happen. That's then I want to know if they're still standing. If a lender has an FHA rate at 3.75 with no points, is that a ripoff? Kind of depends on the credit situation and debt to income ratio too, right?
Yeah, I haven't checked the FHA recently because I haven't done FHA in the last couple months because nobody's been able to get FHA accepted. I mean, they been pushed out. Today, it sounds high. I wouldn't say a ripoff, but it sounds higher than. Like I said, I haven't checked FHA rates here recently. Conventional right now has been, like you said, 2.993, 3.125, 3.25, and typically FHA is quarter to half, 3/8 of a point lower in terms. So it does sound a little high.
Yeah, Terry's saying lender may be paying closing costs? ?
Yeah, that's the thing. Everything's relative. I mean, he might have bumped up, the rate to get $5,000 or $6,000, $7,000 in lender credit. Yeah, because typically you can bump. If I bump a rate up, say, it's really amazing how I can bump it up a quarter of a point, but I can get $2,000 or $3,000. But if I bump it up a half, I might be able to get $5,000, $6,000, $7,000 in closing costs paid. Yeah, I'd say it goes back to everybody's individual situation. I never poo-poo anybody's situation until I see it because, I can tell when people are getting ripped off, or I can tell why people are doing something in terms of buying rate down.
When we were talking yesterday, we were talking about, when's this going to stop? And everybody's just going to every webinar they can to get that magic answer that, July 2021, things will be normal. And all we can do is look and project and everything that we're reading, but we still have to look and say, okay, what could happen? In other words, in real estate, you get a trend. And right now the trend is it's really hard to buy. You're being outbid. You got to suck up as much cash as you can to get into a place. It seems like it's impossible. It'll go away, but when? Right? Yep. So we think, so right now we're looking and we're saying, well, there's an upward trend in interest rates, but it may last, it may not. The Feds don't want it to last. They want it to turn. So you've got that, but then you got the market saying, well, we think you're underestimating how bad inflation is going to be with all this stimulus spending. So that may further put pressure on interest rates to rise, but there could be other things out there financially that just hit us across the side of the head with a baseball bat that completely change the game.
Yeah.
So while we're all trying to analyze things, what kind of things are we at risk for that may make the number of listings greatly exceed the number of buyers?
People talked about forbearances and, like I said, foreclosures, but once again, the data that I've seen, the research that I've been pulling up does kind of make me shift to the fact that these forbearances are going to be more of a gradual, because they all didn't go into forbearance on June 1st. There was some that was March, April, May, June, July, August. So, there's a staggered amount.
And it's an insignificant number when it comes to moving the bar.
Yeah. So that's out of the equation because, like I said, even if, we are going to see, there's no doubt we're going to see foreclosures out of those. There's no doubt. But once again, with the equity that people have built up, I don't see that being a thing. I think that rates, the Feds want to keep the rates, the 10-year bond's gone from 90 basis points to 162.5. It got smacked around again today. It was down, the 30-year treasury or the MBS coupon was down 52 basis points. So basically, on a $300,000 loan, that changed your closing cost by about $1,500. It went up $1,500 today. The 10-year treasury went, opened up at 154 today, and it closed. It's at 162.5, so it's up 10 basis points, which is a big move. I don't know if some of that was because of Biden's talk yesterday. The numbers, the CPI numbers came out, and it looks like now they say the core inflation rate is running at about 2.7. But that, once again, I like how Barry Habib breaks this down. He says that very few people they're watching that core inflation number month to month. But once again, as I mentioned on the call, I think last week, if you look at the 12-month moving average, we're looking at March right now, or February, March right now. But last February, March was really slow. So once that falls off, you keep moving that 12-month moving average. he said the core inflation rate is going to look creepily scary the next couple months because we're comparing it to last March, April, May, which was slow. And now we're adding in new months where it's coming in hot. He says we're going to see rates probably move up here in the next, April, May, June. But he says he thinks they're going to taper down once we get past those hot numbers.
So that'd be something to really watch because, I mean, think about that equation. So if rates start going up because these bad inflation numbers come in and traders are saying, well, it's here to stay. And Barry's saying, well, you're not looking at the numbers right because it's, it's going to taper off. And at that point, during that transition, buyers are going to be backing off even further, right? Because rates are rising. Inventory is going to start to increase. Prices are still going to go up. But then all of a sudden, when the inflation numbers come back down, people are going to be worried about recession.
Yeah.
And then rates are going to come down and then another jump in housing, another frenzied activity, a short window to get that increase in inventory that's out there maybe.
Yeah. Yeah. I mean, there's another guy, remember that the Bond King says that, remember that you turned him on to me or me on to him as far as just watching him. And he says there's a big short squeeze. There's a big short in Treasury bonds. And that goes back, the Feds now it's been talked about the last week about the Feds doing what they call Operation Twist, where they basically sell short-term, since short-term rates, like it's basically an inverted curve. The shorter term rates are higher than the long-term rates. And they could do an Operation Twist where they sell short-term and they buy long-term. And that was done in like 1970 and 2011. In 2011, it brought down the 10-year treasury again. That's when we saw another refinance boom. And they're thinking about doing that Operation Twist here. It's not, I don't know when. They've been obviously increasing their buying. Europe started increasing their buying too on treasuries. But we saw, when you see a treasury go from 90 basis points or 0.9 to 162, you're talking about, a 60% move in about a month and a half, which is a great move. So, there is probably some shorting going on with the treasury. And he said rates have crept up. I'm starting to see people talk about the fact that, I'm starting to see, I get inklings when I talk to people. I listen to other LOs. You got, buyers that are getting they're just pulling away. They're saying, I'm out right now. I'm out. So that's going to lessen the pressure. And to go back to that trend too, that we were talking about, you look at 2010, when we hit 2010, we hit the bottom in June, July of 2011, actually. That trend was there, but nobody started catching on to it till about 12, 13, 14. It was 2 or 3 years, it was there, but nobody saw that.
Well, that's herd mentality.
Yeah. And that's
everybody's telling you how bad things are. Now everybody's telling you how, that housing is going to go up forever or it's going to crash. And it just, it's tough. The Talamer here, the question I got says, not to stop you there, but he goes, latest graph I saw showed 83% of all mortgages have at least 80% loan to value. There's not going to be many foreclosures. And I agree, but then he clarifies and says, I meant 83% of all mortgages in forbearance. That is correct. That is the right number. So there's these numbers of homes that are in forbearance. Almost 90% of them, the last number I saw, had more than enough equity that they didn't need to give the home back to the bank.
Yep.
And,
so, I mean,
this is Stephen. I'll stop you for just a second since we mentioned his name. This is, if you ever want to get geeked out, go watch Stephen Van Meter, and he explains bond. And sometimes you got to play that video 3 or 4 times to understand what he's talking about. But he uses little paper arrows, and people give him a bad time about his paneling. He's got paneling
1970 paneling.
Yeah, and you just think, and this guy, he's a brilliant guy, and you think, it's just like he's in a little Rambler in Ohio or something with all that paneling on.
He gets going, boy. He gets going on his charts, man. I thought I had ADHD. He throws about a chart every 15 seconds, and it's like, I'm an econ major and been, in finance 34 years, and I sit there and I'm kind of like, Holy cripes.
Oh, I can't keep up at all. You know, he does a live show on, like we do, on Sunday nights called Sunday Charts. And he's just like, and bam, a bam, bam, bam. I'm like, slow down. Like,
I know. It's
I
crazy.
can't keep up. But if you're in, you know, if you're really into try and look at the macro, and he uses that word a lot, what's going on above the clouds, that's the guy.
That's
And
what I try to do too. I mean, I try not to get caught up. I mean, I try to look at that macro overview.
yeah,
Like,
yeah.
you know, and
Yeah, because we're looking at what's going on now, but I'll never forget, you know, I do have that one client that his job is to audit the banks. And I asked him once, what is there anything keeping you up at night? And this is earlier last year. And he goes, not unless, you know, things don't get better. You know, he says, if people can't go back to work, then I'm going to be staying up at night. But there's so much money being injected. And a lot of people are not fans of Janet Yellen because she believes, you talk to a lot of financial people and she scares the crap out of them because she honestly believes that you can spend money into infinity. Don't worry about it. Rates are so low that you can afford it. Well, the government doesn't borrow something so much on a fixed rate like a mortgage. You know, that rate gets adjusted. And then when it gets adjusted, our payment as taxpayers goes crazy. And then we've got all kinds of problems. So she is not a fan by many respected financial people. And so that, and I'm only bringing that up not to convince people that she's good or bad, but what I'm saying is there is nervousness in the financial markets.
oh yeah.
And that's, I think, the outside thing that it's hard for me to watch closely, much easier for you because you understand it, that there could be something just kind of flying in that nobody even sees coming that's going to lead to a banking crisis.
Well, it's like today. I mean, you know, the mortgage side, it was just announced last night that, and this is something that I want to also bring up is that, give me 1 second here. I'm not as adept on the screens as you are, but yeah, there's a big hit to mortgages. Basically, it says here that second home and investment mortgages, Fannie Mae and Freddie Mac, they announced March 10th, which was it yesterday? No,
Yeah,
Wednesday.
2 days ago.
They announced
Yeah.
they're going to be limiting. They're going to have lenders and investors. They're going to be watching their portfolios to make sure that they don't go over 7% of their overall loans that, you know, that Fannie Mae purchases. So yeah, basically 7% of their overall loans they purchase, roughly half of their historic levels, effective April 1st. So that says, what does it mean to borrowers seeking investment in second home mortgages? It says out here in this article, turns out it means a lot. They're going to be adding a new, what I have mentioned before on this video, with when people call for a rate, I often say loan level pricing adjustments. Basically, that's a fee that Fannie Mae or Freddie Mac will charge if you're at a certain loan to value or certain credit score. If you're 680 to 700, it's a higher, basically it's just pricing. It's a higher price. It's a fee that they'll add on to the loan. And that's why a guy who's got a 660 FICO score versus a 720, their fees could be $5,000 or $6,000, $7,000 difference. But they made this.
Why are they doing that?
See, they'll do stuff behind the scenes. They're doing a computerized they do updates every month or every couple months. When they want to tighten or constrict credit, all they have to do is change the algorithm accordingly to tighten up. You know, if I was to put in, say, a loan 2 months ago that had, say, a 690 FICO score, 90% loan to value, you know, yada, 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 I would get approved eligible. Now, if they tighten up, they could turn the algorithms. They can just tighten up the algorithms over the weekend and say, we don't like 690. You've got to be a 720. I could take that same loan and run it in the computerized system today and not get an approval. It happens behind the scenes. And this is what they're doing with second home and investment mortgages. They're going to be adding on, like this one lender, Penny Mac, it says, is going to add a 2.25% cost to new second home mortgages, regardless of equity. And it says for investment properties, with less than 25% equity, their loan level pricing charge is going to be 5%, 5 points. So what Fannie Mae and Freddie Mac are telling, they're just trying to tighten up the credit bucket. They probably see something, they're trying to get ahead of the curve, and they're just making it a little bit tighter for second homes and investment. So either you pay cash or you get hit with this. And not every lender is going to be a little different. I talked to one lender today and he said they weren't even aware of it. And then I got another lender that said, yep, we're putting it out tomorrow morning. So it's really hit and miss on different lenders.
Wow.
So it's going to add, that, and that was on top of that point. Remember that 0.5% fee that they added on for refinances back in May. I think it was May. They added that 0.5 point fee. So, what's frustrating is ticks me off is that the government, they talk about mortgage people and their fees, and that's what made the crash. That's why we got to regulate mortgage lenders and brokers and bankers, and because you were the bad guys charging all these fees. The government here, they come out and start smacking
$2,500.
Yeah. Start smacking people with fees left and right. It's like, I'm sorry. I just tell them, go to hell. I get so damn mad. I get so frustrated. Excuse my French, but I just get so frustrated when I see them. But I know why they're doing it. Like you said, they're trying to squeeze the credit bucket, maybe to tighten it up on their end. They probably see something down the road. They're trying to. This is a way of them tapping down the market a little bit too.
Just trying to get.
They want to keep their portfolio. They want to keep their portfolio. No more than 7% of overall loans are either second home or investment mortgages.
Well, they're seeing something we don't see, so that's hard to tell. It's kind of like, I get so upset when I see them haul these oil executives to testify in front of Congress because economic trading and the commodities market has raised the price of oil, and they call them greedy. But as soon as oil get down to where it was just a few months ago, like Washington State, they want to add an 18-cent tax on gas. Well, nobody gets to haul them in front of Congress and complain about raising the price of fuel. And there's more federal, it's hypocrisy at its greatest. So it'll drive me crazy.
The government, tries to play, they say one thing and they do another, but they said bottom line demand for second homes and investment properties will be greatly impacted by the financial FHFA, the Financial Housing Authority. He said outside investors may eventually purchase, more of the, they might, and that's another thing too. Fannie Mae, Freddie Mac is trying to get away from some loans, so they tighten up a credit, and they might move these loans to what they call non-QM, non-qualified mortgages. So there's different banks that will cater to that. So maybe Fannie Mae, Freddie Mac is trying to slowly transition out of that too. So they're doing it for a reason, and that it's like anything, any politician, they're not going to come out and tell you that the exact reason. There's always a modus operandi, and that's why I try to kind of poke behind the scenes to see what the hell's going on. But this thing just came out. Yes, it just really came out yesterday. It's just started.
Yeah, you don't ever get any warning on those kind of things. Oh, hey, Monday.
Yeah. Well, that's the thing. It's just that's the stuff that catches you by surprise, and there's nothing I can do about it. The one good thing I've got, availability is I'm not locked into one bank. So like I said, some banks didn't implement this, some did. So I just have to search around and, for right now and see what's going on with each bank.
There's another thing I'm watching very closely right now, speaking of Congress, and it's not going to see the light of day in the Senate, fortunately for now, but they came out with what they call the Pro Amendment, I think it is. It's going after the gig worker, the Ubers, the Lyfts, the independent contractors, the 1099 employees, and it has all kinds of language in there that gives them freedom to join a union, and it gives them and it makes other small businesses have to they can't just 1099 these people if they hire them. So they're trying to get more people as employees. And it seems like, okay, great, you'll do that. It's more of a an incentive to try and boost unions when you boost in. The other thing is too, outside of that, is it's very dangerous with huge repercussions. Couple examples. If you're getting rid of all these independent contractors and you're just talking about Uber and Lyft. Now, I used to manage independent contractors. I know those contracts like the back of my hand. We signed them and read them, and I've been to court, and so I get it. You get rid of that and you tell companies like Sara Lee Bread, Oro Wheat, Flowers, that now they're all employees. You've added 7% in taxes on the employer side. Now, take that a little bit further. And yeah, they tried that in California. This one is even stricter. At Silver Rose Gaming came in and said they tried that in California. This one, they added even more teeth to it. But guess who else is a 1099 employee this might affect? Me.
Real estate agents.
Now, think of all the real estate agents out there. We're independent. So we have our own marketing.
Did I get the answer right?
What's that?
Did I get the answer right?
You did get the answer right. Yes.
Okay.
You can keep the duck. But the, so that could have, if that were allowed to grow, right now that would hurt real estate agents and it would hurt consumers. And this is just my thoughts, but here's how. You can negotiate your commission with me. If I'm working for an employer, that employer is going to have added costs, and he's going to have very strong limits on what I can and can't do because he has costs associated with having me on there. If I only sell 3 houses a year, I'm going to be fired. Okay. And whereas now people get their license, they kind of do it as a hobby. Yeah, they sell a house every once in a while, but the expenses and the limitations on service that you'll get if all these 1099 employees or contractors have to become employees, it just lowers the level of competition across the board and doesn't give me the leeway to put a different program together for you. For example, you and I are offering $1,200 in closing costs to our YouTube subscribers in any transaction. And we can't do that if I was an employee. We're doing that because it's an independent decision. Those types of things are wide and varied. And so I say watch that very, very closely, not just for real estate, but in anything else. And people, you think there's going to be that many Uber and Lyft drivers out there if all of a sudden they're all classified as employees? They're doing it because they like the flexibility. Oh, I think I'll go to work for a couple hours. Bam. I think I'll stop. You're going to get to do that if you're an employee?
No, exactly.
So I'm off my soapbox. That one scares the living daylights out of me.
Hey, I do love your, I just want to give you a side note. I've been loving your YouTube morning shows. I will say though, that I think you're gonna start tapping down the demand in Arizona after your last couple ones with I think you're scaring people with the spiders and the snake and the monsoons. Don't tell people that you got to build up Arizona. You can't tell them we got all these critters crawling around and snakes.
Yeah, and then I show you the bad weather too. But hey, look, it was a request from a subscriber, and we try to help our loyal subscribers. And so I
was watching. I'm like, he's gonna scare the gajibas out of people.
I probably did. Next day I said, I hope I didn't keep anybody up at night. David says, I had 77% equity. FHA is still charging me $92 title insurance. I have a 3.5% loan though.
Yeah, it's not title insurance. It's mortgage. I know what he's talking about. It's mortgage insurance. And regardless of, an FHA, regardless of whether your loan, it does not matter what your loan to value is. You could be at 40%, 50% loan to value, and you're still going to have FHA mortgage insurance. It's basically, it does not matter on if you're below 80%, you could be at 60 or 70%, and they still charge the mortgage insurance. That's why a lot of people will, refinance, maybe you're at 3.5 and maybe they get a little bit lower rate, but they want to get off that mortgage insurance because it's not doing any good. So it's
go conventional. So,
yep.
Well, cool. Tuesday, talking macro, and we're gonna have a conversation with a gentleman with DeGreen Financial, Sam DeGreen, and they manage portfolios of people that have a minimum of $1 million, and they talk to them about how to preserve their wealth. So they are always looking at data that makes them need to shift their strategy in investing. So I want to pick his brain and see if there's anything in that arena in wealth preservation that they see that keeps them up at night. And what kind of indicators do they see where they need to make a change in investing? And is there any of that that relates to our world in real estate? So that's going to be Tuesday morning. I'm looking forward to that. In the
Well, it's gonna be a
meantime,
lot better than it's gonna be better than snakes and scorpions.
it's going to
And
be better than snakes
it
and
won't scare
scorpions.
people.
It's not coming close at all to a free ceramic mallard duck, though. So,
True.
you know,
Yeah.
we know that was hard to beat. So,
Yeah.
speaking of ceramic mallard ducks, I would still lean towards the free webcams. We got 39 entries now, so jump in and take your chance. I can't wait to do that drawing on the 26th of March. So you've got plenty of time to enter. Until
right.
then, everybody have a great weekend. Pat, you do the same.
All right, sir. Everybody, take care. Good
See
talking
ya.
with you. Bye-bye.